Alright, ladies and gentlemen, the MarketPace is back. It's been a few weeks since I was on here, and since then we've had a decent amount of developments in the stock market and my portfolio that I want to share with you all. But first, as always, I do want to do a disclaimer that this is not meant to be financial advice. True financial advice takes into account your age, income, many other factors like financial goals, retirement. All this information, I have no idea about you, and I'm also not any sort of actual financial advisor, registered or otherwise. What this video is all about is just sharing what I see in the markets and the news that I see in the markets, my opinion of them, and how I'm trying to execute and take advantage of all that stuff. All with the goal to maybe help with your ideas at home, with your investments and your investment plan that you should work out with your financial advisor for your financial plans at home. And as such, I take no responsibility for the results of actions you take as a result of these videos, or this video in particular. And I do encourage you to talk with financial advisors to work out a plan of your own. Oh, and also, if you do get something out of this video or any other of my videos, I would love to see a like button pushed, or a comment left, or a message sent to me. This way I kind of know there's some benefit that comes out of these videos. I'm not just making them for my own good, which there is definitely some good. Me making these videos kind of forces me to have my opinions and my, I guess, facts straight to share them with other people, as opposed to me acting impulsively on opinions that may not be concrete, which does help me improve my results personally here. So, on to the video. Let me start with just a recap from the last video I had about 3 weeks ago. So the S&P 500 at that point was 2578, and now we are at 2939 as of the close of today, which is the 29th. So that's a gain of 14%, so it's a nice significant rise there. In the last video, I was trying to do a trade because I was expecting the market to fall at some point since it wasn't passing a resistance level I had mapped out. This trade did fail within a couple of days, within the week of me putting it on. So I lost a little bit of money there. Wasn't anything too significant since I managed my risk and make sure no individual trades are going to knock out my account altogether. And as I had said in that last video, if that trade were to fail, I would get more long the market and have a more long portfolio by investing in this ETF called DFEN. And as such, I did do that. Now, unfortunately, I was a victim of one of the most obnoxious and common, I guess, things that happen to investors and traders, and that is being wrong even while you are right. So, as I did say, I was expecting the markets to rise as a result of it breaking through that resistance, and they did rise, as I just said. The S&P did rise about 14%. But the way I tried to capitalize on that in the DFEN stock, which typically overperforms the S&P 500, that was wrong. It didn't really perform as well as the S&P 500 did, and as a result, when I was kind of noticing that it wasn't working the way it should, or working the way I was expecting it to, I had taken about half of the position I put on off at about 15% loss. So I did take a small hit there. I do still have the other half of that position I put on, still going long and still holding it, because I do still believe that DFEN will rise like 100 to 200% over the next year or two. I just wasn't willing to have so much of my portfolio into it while it gyrates up and down in a way that isn't following the S&P, the markets overall, during that time. So I took some risk off on that position. But I do still have a good amount of DFEN for more of a long-term investment, and I'm still pretty sure that it will rise from the point I bought it to somewhere in the 20s to 30s, which would be about 100 to 200% gain, which would be nice. So as I said, though, I was right. I was wrong while I was being right. So if I had just invested in the S&P 500 3x leveraged ETF, or SPXL, that symbol, I would be up about 20% as of today. from when I had bought the DFEN. So kind of like a little lesson I'm taking out of this is instead of trying to be elegant and trying to leverage and be in things that are going to overperform the market, just get in the S&P 500 since that's what I'm typically tracking. Leverage it. Keep it kind of simple. Don't be more elegant. Don't try to like really force out squeeze out every single percent you can get out of this thing. Just go with what works. Kind of the KISS principle, if you've heard of that before. Just keep it simple, stupid, right? So I'm gonna try to do that going forward. Just keep to my basic plan of be leveraged when I know things are good, be hedged when I'm not sure what's going to happen, leverage to the downside when I know things are bad, and all that in between when stuff is just okay. Be fully invested in the S&P 500 and let the market do what the market does, which goes up a little bit, goes down a little bit. Overall, it does go up. Alright, so that's basically the recap. Well, at this point, though, my portfolio overall is actually back to the point that it was at, or at least it's within, I think, 1 to 2% of the point that it was at before all the coronavirus stuff was kind of happening and the crisis happened where the market dropped about 30%. So I have mostly recovered from that major drop, while the market still is down about 10 to 15% from that point. So right now I'm overperforming the market by about 10 to 15%, which I'm pretty happy about, even with the drawback of getting the position on DFEN as a loss and the drawback of getting that trade that I was expecting markets to go down and having to take a loss there as well. But thanks to risk management, good proper hedging, and some of the lessons I try to put into these videos where I can squeeze them in, I'm back to where we started, and now is the point where I can hopefully start to get some gains and actually make a positive percentage on my year, 5 months in so far, if the markets continue going up, since at this point I am fully long the market. I'm in a diversified portfolio and the S&P 500 through the SPY ETF, SPY. So if the market goes up 1%, my portfolio should roughly go up 1%, and vice versa. If it goes down 1%, my portfolio should go down about 1%. That's about the recap of everything from the last video. So going forward, I just want to talk about a little bit of fundamentals, especially some news that dropped just today, Wednesday the 29th, April 29th. So I want to go over some news, some fundamentals that are happening, and then I'll go to some charting, where I think the market's going to go and where it might change if it happens there. Alright, so some news. Wow. So today had a lot of news, or at least two major big stories. First, let me cover Gilead. Gilead is a pharmaceutical company, and they have a drug called remdesivir. And a study came out showing that remdesivir was relatively a valid treatment for coronavirus, or COVID-19 anyway. So this gave the markets a good amount of boost and helped get rid of some fear that this coronavirus is going to keep everyone inside and keep us on lockdown. Once there's a treatment available, lockdown should start letting up, business should start resuming, and once we have a vaccine available, then the coronavirus is basically as good as gone as far as a concern for the markets will be. So any treatment we see and any progress on a treatment we see is definitely good for the markets. On another note, though, from what I've read of this research, it's not necessarily a groundbreaking change. So if you're really concerned about the coronavirus, COVID-19, don't necessarily rely on this drug to necessarily save you. Definitely rely on good health practices, washing your hands, try not to get the virus at all to begin with. And if you do happen to get it, try to reduce inflammation and a bunch of other stuff. I'm not necessarily a doctor, but definitely it's not necessarily a groundbreaking 100% treatment as far as the research I saw said. In fact, it seemed to be just another drug that actually gives you about the same results that I read about as a normal no treatment type of treatment. So still about 1 to 2% of people still die, and you still go into the ICU, and that lasts about 2 to 3 weeks. Nothing really changed, but whatever. The thing that matters is if the FDA approves it. If the FDA approves it as a treatment, the market will treat it as a treatment, regardless of what the research actually says. I'm going to leave that to other people to decide their opinions on. A cool thing about the FDA, though, I guess you can say it's cool, at least for the market's valuations it's cool. They have said that they may approve an emergency approval for this drug based on this research as soon as next Wednesday. If that ends up happening, we could see a nice rise in the S&P 500 to maybe even take out 3,000, maybe even like 3,100 on the S&P. I'm not going to necessarily guess numbers, though, but we can definitely see the markets continue to rise if this drug is approved as a treatment in an emergency situation by the FDA as soon as next Wednesday, which is only a week away. So that's good signs for treatments on corona, so that's a nice positive for fundamentals. The next thing is the Federal Reserve had a meeting today. In that meeting, they have once again confirmed that they are willing to do whatever it takes to support markets and support the expansion, keep things running, keep financial systems circulating, keep the money going, help businesses not completely go bankrupt, help banks not go bankrupt, etc. They are willing to take whatever money that they can take out of their unlimited pocketbooks and put into the economy as needed. One of the major ways they are doing this is by buying bond ETFs. So this is kind of a get-out-of-jail-free card for any company that has a halfway decent credit rating. They can just about always issue bonds right now, and through a couple convoluted ETFs, the Federal Reserve is there waiting to provide a backstop and buy those bonds to support them, meaning that if a company needs some extra money right now to get through this crisis, there is liquidity and money available in bonds that they'll pay a small percentage of, but paying a small percentage year after year is better than going bankrupt and being out of business. So there's always now that backstop that the Federal Reserve has provided, in addition to giving the government lots of money to provide fiscal stimulus, and in addition to Federal Reserve providing a lot of money to the repo markets, which frees up more money to go into the stocks and provide liquidity to, again, raise stock prices, which I did touch on in a few videos ago back. I think like the second or third video I put out there, which I definitely encourage you to look at. That was a pretty decent one. Actually, no, it was the first video. So yeah, first video, easy to find. So that's basically the fundamentals. Oh, actually, there's one more fundamental that just came out, actually, like an hour ago. That is the only negative that's really out there right now, fundamentally wise. Steve Mnuchin, the Treasurer of the United States, has said that there's not going to be a bailout for the oil companies. So that's definitely doesn't bode well for oil companies. However, this isn't exactly spelling doom for the S&P 500, since right now the oil and energy like sector of the S&P 500 only is making up maybe about 5% of the market at the moment, and of that, a lot of it is more electrical based, not necessarily all in on oil. So say all oil companies just went bankrupt overnight or something, only maybe 2 to 3, at most 5% of the S&P 500 is actually affected by that. The rest of it is just affected by by coincidence, just because it's part of the S&P 500, not necessarily because it is part of their business. So even if we see a couple of oil companies going down, going under, it isn't going to spell certain doom for the S&P 500. In fact, it might even make a good buying opportunity to pick up some shares if you haven't already. Now, let's see what else. I think that's basically is the fundamentals I wanted to cover. Yeah, that's basically everything with the fundamentals. Let me slide over a bit. Hopefully I can put up a chart here in the video. Yeah. Or I'm just going to have to change frames and put up a chart instead of me. So I just want to talk about oil. I have a chart about oil and the S&P 500. So first off, oil. In the news, you probably saw that at one point oil went negative, meaning that you could actually be paid money if you were able to take receipt or receive oil and store it somewhere. So you'd be paid money to buy oil, and which kind of saying that oil is at the time worthless, which is a complete bold-faced lie in a way. Oil will basically never be worthless. It always has some sort of value to it. Someone's going to buy oil for something at some point in time. But right now, there's so much out there, and demand for it is so low because there's no shipping. Well, not no shipping, but there's very little shipping. There's very little air travel. There's just very little need for oil since a lot of things are subdued thanks to the quarantines and a lot of businesses being out of business for a time being. So the major reason why I want to talk about oil, though, isn't necessarily an opportunity I've seen oil for trading, but it's a signal. When oil starts to rise again, it won't be a result of supply being cut that much. Every oil producer has pretty much openly said that they don't want to cut their supplies. They want to keep pumping, and they don't want to shut off all the pumps because to turn it back on takes time and takes a lot of money and effort. So they want to keep pumping, and that's going to keep raising the supply, which does lower the price until demand rises. Once demand rises to match that supply, or at least in some way, shape, or form, it's going to raise the price of oil. That's going to signal that demand is back out there. That's going to signal that transportation is on the upswing. Ships are going to be delivering things again across the ocean. Trucks are going to be delivering things across the state and country. Airplanes are going to be flying across the state and the ocean again. Demand will be back, essentially. So instead of trying to guess based on earnings reports and revenue and what this company is saying and that company is saying and these forecasts, we can just look at the oil price, and once it starts hitting the high 20s, low 30s, that should signal that demand is back, which should signal for the economy that demand is back, that the business is back on. People are going to be buying raw goods again and transforming them into finished goods and then selling them again. So at that point, it's going to be the nation is on its way back to firing on all cylinders, or at least getting closer to it, which will definitely be a good sign to maybe go putting in a little bit of leverage, or at least go long the market again, or just a good sign that the economy is healthy and on the upswing, and that basically once we see that, we can expect all-time highs to come back. If we don't see that, we should be nowhere within 10 to 20% of all-time highs, in my opinion. Well, maybe like 10%. Since we're already within 20% of all-time highs. But we should not see all-time highs right now because business is subdued thanks to quarantines and thanks to a lack of demand. When we see demand come back as a signal from oil, we can expect those all-time highs again, which should help us have more faith in having our money in the stock market. Right, and moving into the S&P 500 chart, we have had a channel that we've been in for this upswing. So this is kind of what I'm looking at to see if we do have a potential downturn. We are at risk of having a potential downturn since, as I said, there's very little demand. Businesses, many of them are still shut down. We are still in quarantine. There is still a big risk of foreclosures and defaults since people maybe can't pay their bills since they're out of work, and maybe unemployment is falling short of what they need because maybe they're living out of their needs, or just unemployment is not meeting their needs, one or the other. If these things do start to compound and really affect the market, we could see another drop. But as I did say, the Federal Reserve and government has been providing so much money and are willing to provide whatever it takes to keep the markets stable and away from falling to certain doom. So any sort of drop we could expect shouldn't be too crazy. I'm thinking maybe 10% at most. Of course, you got to read the market. Never think you know better than the market. Always think the market knows better than you. So go with what the market says. And that's what this chart's all about. If those things start to compound and actually affect the market prices, we will see the price of the S&P 500 drop out of this trend to the downside. And at that point, I would be looking to hedge my portfolio to a delta neutral position again, because I'm not really sure how far it'll go, how fast it'll go, or if it'll even continue downward. But I just know I don't want to be a part of it. So if it does break out of that, I'm going to be changed to a delta neutral. But until then, while it's in this channel on the rise up, I'm in just no leverage, but fully invested in a diversified portfolio and in the S&P 500 index, or the SPY, SPY ETF, and a little bit of Bitcoin to hedge inflation. And that's basically where my portfolio is right now. That's pretty much where it'll stay until we see this break down. And until then, we could only expect the rise to keep going up in this channel. So that's about it. Something I did actually miss that I just kind of reminded myself, I do want to talk about inflation just for a quick moment. Since the government is pouring money into the economy right now, Federal Reserve is pouring money into the economy right now. They still haven't. They did the last stimulus bill of $6 trillion. Did the other stimulus bill of a couple $2 billion for Paycheck Protection Plan and other business loans. A lot of money is being put into the economy. And there's another couple of stimulus bills that are in the works right now. One of these being a proposal for the Treasury to mint two $1 trillion coins that they sell off to the Federal Reserve for US dollars to use in the economy. And the condition of those $2 trillion is that the Federal Reserve will never get paid back for them. So meaning there will be a permanent $2 trillion that just adds into the economy just like that in a snap that will never go away. Not that the United States is very notorious for paying back its debts anyway, but these $2 trillion are not even expected to be paid back ever. So that's going to be like a... As far as causes of inflation, that's caused by money being introduced into the economy with the demand to follow it, which allows for higher prices to be paid on the same goods, which are still worth the same thing. Meaning a bar of gold is still worth a bar of gold, but in US dollars amount, it's worth more dollars. A share of Amazon stock is still worth a share of Amazon stock, but in US dollars amount, it's more dollars. That is what inflation is. A loaf of bread is still going to be worth a loaf of bread, but in US dollars amount, it's going to cost more US dollars. So we can pretty much expect that to happen over the next couple of years as demand comes back, assuming demand comes back, which would be kind of stupid not to assume demand comes back, because I know personally, I still want to buy a ton of items on Amazon, and I still want to go shopping. I still want to go eat a nice meal. I still want to go, buy a house, buy a boat, buy a car. I don't know many people that don't. It's just right now is not maybe the best, safest time to do it given the economy we're in. But most people still want to do those things, and that is basically the definition of demand. If people want to do those things, that brings the demand up. I see no reason why people wouldn't want to do that stuff. So, as we see demand come back over the next couple of months and years, we'll see inflation happen, and you do want to be hedged against inflation. So there's a few ways of doing that is directly with things like gold and Bitcoin, assets that are like physical assets. Even though Bitcoin's digital, it is still in a way a physical asset. And another great way is stocks. So I really encourage people to be invested in stocks and be active in the stock market, even though it does sound scary given the economy we're in right now, given the all the uncertainty that's floating around. It's like 2008, 2009, with the last stimulus bill that happened during then. That was the last time that we could expect a major surge of inflation that's, man-made in a way, because the Federal Reserve and the government kind of teamed up to pour a ton of money into the economy. And as a result, the last 10 years since 2008 and 2009 have been pretty great. We've gone up several 100% in just the S&P 500, and if you had leverage to that, it's you'd be up. I remember seeing a story about someone that put his life savings, and maybe 30 years old, he had like $100,000, put his life savings into that 3x leveraged S&P 500 ETF, SPXL, and I think sometime last year, before this last major fall, he is now a millionaire because the S&P 500 went up several 100%. Add 3x leverage to that, you got like 1,000% there, and that's 10x. 10x times 100,000, you're now a millionaire. So I'm just saying, expect inflation. As inflation takes hold, that's going to raise stock prices. It's going to raise asset prices altogether. So it's a really important time to get some money in the market and be sure you're invested. And the only major concern we have right now is if the S&P 500 breaks out of this channel that I showed on that chart before, and at that point you can be hedged to a delta neutral position for a short amount of time, or using the ETF I showed in my last couple videos, or maybe an option contract or some other means. So just because we're in uncertain times doesn't mean that it's unmanageable times. That's kind of what I'm saying. And to hedge against inflation, you need to be invested. Don't be hoarding dollars right now. As inflation takes hold, those dollars are going to be worth a lot less, and that's going to kind of bite you in the ass in the future. So that's basically my lesson for today, inflation. Again, if you got something out of this video, drop me a like, shoot me a message, shoot me a comment. It really does mean a lot to me, and it shows me I'm actually doing some good for the people out there. Because although these do help me kind of keep my mind straight, keep my ideas together, which helps my portfolio, I don't need to be taking a few hours out of my day to make these videos and post them. It is more for people out there to help them come up with ideas, help them come up with theories, or learn theories of market strategies, things like that. Things that I've learned over the last 3-4 years, like living and breathing this stuff. So yeah, that really does mean a lot to me if you do drop likes and comments and such. Let me know you're watching these. If you did get something out of it, or want to talk about one of those ideas or one of those symbols, stocks, or have some ideas of your own, comment me on my YouTube, Instagram, Facebook, whatever. Okay, that's all I got for you all tonight. I think things are actually in pretty good shape. We could possibly drop again. The market will signal to us in the way I said if we do. And outside of that, until next time, happy trading, guys.